Good morning, everybody. Welcome to the Game Plan. My name is Gareth Soloway here at VerifiedInvesting.com, and we're going to get into the charts and the data to make educated, high-probability decisions on trading the action today. All right, follow me over to the big board here. Let's get into the pre-market action on the S&P 500. This is the SPY tracking ETF, so it gives us a good basis. This was yesterday, so again, yesterday kind of started out flattish, chopping a little bit green. We then had a beautiful rally, but then just into the end of the day, we saw a dump out that took some of those gains away. Now, it was still a decent up day, second up day in a row, Friday and then Monday. But today, as we can see, this is yesterday after hours, and then at 4 in the morning, the market or the spiders open again, and we can see that we are trading lower. So markets are trading lower here in the pre-market. Now, the key things to watch this week are coming up in full force. Number one is the Fed decision meeting. That is tomorrow at 2 p.m. We'll hear from the Federal Reserve. They're not going to raise rates. They're not going to cut rates. It's all about the commentary from Jerome Powell in his press conference. What is he going to say about the economy, about tariffs, about the outlook for interest rates? Right now, the markets are pricing in 2 rate cuts this year. The question is, will that number go up or down based on what he says tomorrow? And the markets will react accordingly, all right? So again, we will keep an eye on this. Now, if we go to the daily chart, we knew we were into some support, right? It was an oversold scenario where we went down for basically 3 weeks in a row, almost in a straight line. We tagged this little parallel in here and ultimately got a little bit of a bounce. Now, the big question, we discussed this yesterday, is how big could this bounce be? Is it over already because the markets are trading down, or is this just a pause, pullback, maybe some profit taking ahead of the Federal Reserve tomorrow? We won't know for sure, right? But what we do know is that if we rally up, this is going to be your first level right in here. This former low now becomes resistance. So you can see it bounced here, it came down, bounced. So then when you break lower and bounce, this now becomes resistance. So that would be the first level where, again, if we rally back, I might start nibbling on some shorts in this market. All right, if it goes through there, then you always have to look at that scenario, right? Even if you're going short here, generally I don't go all in anyways, but the idea is if it goes through here, you could do a retrace to the scene of the crime. This longer trend line, we could see a move up there, although again, unlikely unless we see a respite in the tariff scenarios, right, of these constant threats, the economic data, we need that to stabilize, other things like that, especially in regards to corporate profits, all right? So that's what we're looking at on the upside potential. If we start to break down and we come down and take out this level, where would be the next level? You got to probably go back to the August major correction low. This was about a 10% drop in the markets right here. That was the last big correction until this one here. That now becomes a major level of support. My line's not going to be perfectly straight, but somewhere in that vicinity would be another major technical target for the S&P 500 to come back into. All right, let's take a look at a couple other things here. So number one, we haven't gone over the 10-year yield in a few days. Taking a look, the 10-year yield remains basically chopping sideways. And I think part of this is waiting to see what happens with the Federal Reserve and their guidance in tomorrow's meeting. The only thing that's catching my eye is the potential for a head and shoulders to be forming, right? And if we look at this, we can see there's a shoulder, that's your left shoulder, a head, and then could this be a shoulder forming on this side? And again, we don't know yet because it has to curl over and come back down in the next week or two. But if it forms that, the reason why that's important is because we can then go on to calculate the target of the downside fall in rates. And remember, head and shoulder patterns are bearish. Now, how do we calculate that target rate? If you've been following along for months at this point, I'm sure you guys already know. But essentially what you do is you take the high of the head, you drop a plumb line straight down right to the neckline. So this is called the neckline, the connector from essentially armpit to armpit or shoulder to shoulder. And you take that distance, pull it down, and wherever you break, okay, now this is a flat line, so it's not going to change the target, but wherever you break, that now becomes the measured move to the downside of the target, or where you'd expect it to go. And what we can see here is essentially that brings us down to about 3.5% as a downside move. Now, again, a lot of us would say, oh, that's great. The yields would be going down. Mortgage rates would be going down. Those are all true, but the kicker is this, right? The kicker essentially tells us that what this means is that if rates are going to go that low, things in the U.S. economy are not good, and you're likely seeing a spike higher on unemployment, and again, a very big slowdown in the economy if we're seeing things go that low. All right, so again, that's, it's a double-edged sword. Yeah, mortgage rates go down, and lots of, interest rates go down, but at the same time, it can tell us that the economy is not doing too well. Now, flipping over to the U.S. dollar, by the way, had a head and shoulders pattern right here. You can see it broke, kind of did a retrace, and then collapsed right into target. It's now holding this technical support right here. Now, the kicker is this, is that as we hold but don't really bounce, it's weakening this trend line. And again, in fact, let me go over to the big board and kind of dissect this on an educational basis. So when you hit a trend line, the optimal scenario for traders is to get a big bounce, right? You hit a line and you see a big bounce up. The negative when you don't see that big bounce is that essentially it's what we call here like the bouncy ball syndrome, right? Where a ball dropped from a high level down, we'll see a reflex bounce. But the problem is the bounce is smaller, and then you hit and you hit and you hit and you hit until you roll off a cliff. And that's the problem here, is that you're seeing a very minimal bounce in the US dollar, and it's kind of just chopping on this line, which what do we know that's creating? What type of formation in technical analysis is it creating? You have a down move, sideways consolidation, that's called a bear flag, right? So again, this is leading me to think that if this continues sideways for another 3 days, a week, 2 weeks, whatever it may be, it's basically prepping for another breakdown in the US dollar. And listen, Trump has said that he wants a weaker US dollar against other currencies. Generally, that helps in trade. It can help the economy, although again, it's not necessarily good for us because a weaker dollar means our buying power goes down overall. So it's kind of a double-edged sword again, just like rates going down are a double-edged sword. All right, so let's move on to Tesla here. Now, we got to talk about Tesla because Tesla's coming down this morning in the pre-market. You can see it's now trading around 228. So this did get a nice bounce off this technical zone right here, but now it's starting to collapse, and this will be in a trade that we're probably looking to day trade today. The big level is going to be this next gap fill here at around this 213 level. So there's a gap fill right here. You can see right in here, we never touched it. We never filled the gap. We pierced the top line, but we never touched the bottom line, which is gap fill. So at least on a day trading basis, that's going to be a big level. The question is, if it continues lower, how low could this go? And in essence, I was doing some analysis on this, and you got to start looking back at your March 2020 lows and finding trend lines. And so what we do is we connect that low from March of 2020, which is the COVID low, to the bear market low of 2023. And then right through here to about the 165 level. Look at how it connects perfectly. And I love showing this stuff because it shows how trend lines, it's not arbitrary, right? They actually find levels that all match up. And what this tells us is that if by chance, and I don't know, remember, I don't know the future exactly. I just know the levels where the probability increases for a bounce. But if Tesla were to keep collapsing, this now becomes a massive level that I would be watching as a swing trader for a potential great bounce, maybe a bounce of 25, 30% even off of that level. And again, it's right around 165 or so. Now, listen, it'll have bounces along the way, all the way down there. It's not going to go straight there, or very unlikely that it goes straight there. But again, it's all about prep work, right? And I think that's important for us to understand, is that as a trader or an investor, doesn't matter, there's a certain amount of homework that we should be doing. Right? You can't expect to just show up one day not looking at charts for a year and be like, hey, I'm going to be knowing exactly where to play these levels on stocks. There's a certain level of immersion that it takes to be involved in the market on a daily basis and know what's going on, know the vibe of the markets, the movement of the markets, to be on point for your trade opportunities. And again, it's all beneficial because it makes you a better trader, a better swing trader, a better investor, which ultimately adds to your long-term net worth or your wealth, right? All right, so that's just something I wanted to go over there. I'm going to turn my attention to gold here, and I want to show you this, guys. This is big. Remember how I was talking to you guys about, and I'll go to the big board for this, we were talking about how gold was likely headed up to the upper band of the parallel. Okay, so this is a parallel I've been following for months and months and months, right? And we know that we take the lows down here. All right, it tagged it over here. We drag that parallel up, and we can see that it goes right to that high, and then look at right there. right to the level. That's the target price as it may be. We're trading at around 3,035. Again, you could touch it a little bit more, maybe pierce it. We're right in the zone. But this now is where I start to say, okay, historically, just taking all emotion out of what we think or feel about gold, whether we like it or hate it, doesn't really matter. This could be XYZ, it could be rocks, whatever the chart is, it doesn't really matter. The point being is that you can see that off of this line, we get these pullbacks. And so as a trader, now I'm starting to say, okay, I'm going to aggressively start to look for that pullback on gold based on the fact that we are now at a level. Now, again, this is a swing trade. It's not a long-term investment. I still love gold mid to long-term. You guys know I've been a big bull on gold for the last 2 years, and it's had an amazing run since I was a big bull and really talking about it. But the key is that even within bull market cycles, which is what we're in, right? I mean, you could have a chart that goes up and to the right like this, right? Like that. That's essentially what gold's done. But along the way, you get extended and you pull back, and you get extended and pull back. And that's where a swing trader can find their zone, where you can be long here, exit up into resistance, short it, make money down, then go long and make money back to the upside and back and forth. And while a long-term investor is just kind of saying, all right, yeah, I'm riding this trend. This is great. I'm making, 10, 20, 30%. Someone else who's a swing trader, you can make 20% here, 15% on the pullback, another 15% on the pop, etc., and just add that up. And that's kind of the idea behind swing trading, and that's what I've done for now 26 years, in fact, of this type of trading, which again is not easy, but once you learn the charts and you understand probability, it does become something where the odds can be in your favor. All right, so again, the idea here on gold is that we're now at a target zone. I still think it could maybe touch 3,045, 3,050. That's a normal pierce of a level, but basically this is where I'm saying, okay, look for the pullback in gold. Interesting that it coincides with tomorrow's Fed decision. I'm curious to see if anything the Fed says causes a pullback in gold. Now, on that same front, if we take a look at GDX, this one's on my radar as well. GDX pre-market is up again today. You can see right up here, having a beautiful little move to the upside this morning in pre-market action, but it's actually getting a little extended. Now, it may not be right at that level just yet, but I start to connect my highs, and you can see right here that we are into, and we'll be actually opening above this line today, but then what we can do is we can say, okay, well, if it does go, where's my next two trend lines of major highs? And notice how I'm pinpointing the highest point here on either side, and then since then, this was your highest point. Big move up, kind of like a mountaintop. And this is obviously your highest point since the current levels. And so really what I'm looking at here is, maybe GDX goes to about 46 and a quarter, but this now starts to look like a good short. Okay, again, 46-ish, 45 and a half, 46 and a half, somewhere in that vicinity. Now, having said that, are there metals out there that I still like on the long side? And the answer is yeah. I love palladium here, guys. Palladium, again, let me zoom out on this here. We can talk a little bit about this chart. I'm actually going to remove all trend lines. I want to show you guys the longer term chart on this. This is palladium. And now you look at this chart and you say, man, what the heck is that? Like some company that's going out of business, right? Based on, here it was in 2022, it popped as high as 3,400. Here in 2021, it was as high as about 3,000. And here it sits below 1,000. Now, listen, nothing's guaranteed. We know that. But what I like to do is I say, okay, well, number one, this chart is beaten down. So if I had to choose right now to buy gold, which has gone parabolic, or another precious metal that has been beaten down, which one would I choose? Well, I'd probably choose palladium. I like things that are beaten down. I don't like paying up for things. Now, listen, I have my long-term gold holdings. I've had them for years now at this point. That's fine. I'm not going to let those go. But ultimately, this now, on a swing trade basis, looks very, very attractive. All right, so you can see the beaten down price. By the way, and one of the interesting factors here on palladium is that it is 30 times rarer than gold. Think about that. 30 times rarer. Now, why is price 1/3 the price? Because you don't have the same hysteria and demand, right? So gold for centuries, for millennia, has been a store of value, and it still is. People want the gold necklaces, the gold bracelets, the gold bars, all that stuff. You don't have the same hysteria over palladium. But for me, who's more set on, okay, well, why do I want to own gold because people like it for jewelry? Nah, I couldn't care less about that. I want to own gold because it's a way for me to protect my wealth from fiat printing of currencies, right? So these, these debts, all these things. Well, in that same thought process, it makes sense. You say, wow, this is 30 times rarer, but 1/3 the price. If I want to protect my wealth, maybe this is a way to do it as well. And again, just a thought. That's all it is. But I like to bring these things to your forefront, to your attention, because again, these are interesting opportunities that I think there's a disparity here. And by the way, you now have palladium. I don't know. I only went back to about the early 2000s on palladium's price, but palladium to gold ratio is the lowest it has been, at least going back to the 90s to 2000s, in terms of the price of palladium versus the price of gold. So again, gold is up here at 3,000, right up here, and palladium is here. Now, if you look back, basically that's at the lowest point in recent history. And those things get my attention, because the idea is at some point I always think about a catch-up trade. Right? Is there a catch-up trade in palladium where maybe palladium doesn't go to 3,000, but could palladium go from 1,000 to 1,500? That's a 50% gain. And it's only a small move compared to what gold has done in the same period historically. All right, so I thought that was kind of interesting there. Let's look at silver as long as we're kind of getting through this stuff. Silver's a little trickier. The silver-gold ratio is not the same because silver has gained recently and it continues to push up. Remember that in here we saw a breakout above this line. That means that in general we'll probably go test this area right here, but then this area at just below 35 is resistance. Bitcoin continues to go nowhere. After the initial break here, we had the volatility, which popped it back up, dropped it back up here, and then back here, came down. But really, over the last 7 days, Bitcoin has done nothing. It goes up one day, or down one day, up the next, and then today it is down. The levels are the levels. I wish there was more exciting things to talk about here, but technical analysis can sometimes be amazing, and sometimes it can just be flat out boring. Right now, support is 73, 72 to 74 is the level I've been giving, and then resistance is 92. Until we break and confirm above or below one of these levels, this is range-bound trading on Bitcoin, nothing more. Looking at oil today, oil is catching a bid. Remember, last week, even 1 week ago, I was saying, guys, I'm expecting a bounce in oil, although a shallow bounce, and that's exactly what we're getting. So again, you can see oil just grinding up little by little here. I still think that my max upside, for the most part, unless something happens geopolitically that could really jeopardize the supply of oil, my max upside's right around this level. You can see this pivot area right in here. And then natural gas is trying its hardest to hold on to this little trend line here. It is forming a bear flag, though, so at some point, if this continues, if it doesn't really surge up soon, this bear flag is going to take over. And again, I think you have another drop to the downside. All right, guys, so listen, there's not a lot of major stocks moving. I saw this morning, again, Tesla's on my radar. Rigetti was down about 7% pre-market. So as a trader, I'm always focusing in on, okay, when I get in the Apex Live day trading room with my traders, what are we going to focus on? So there are some stocks out there, but in general, the markets are really looking towards that Federal Reserve decision tomorrow and the commentary that comes with it. And we are in a period where we had tons of volatility the last month or so. Now it's quieting down ahead of the Fed. I do think once the Fed comes out, the market refocuses and starts to get volatile again. But again, I always want to bring you guys the latest insights here from Verified Investing, from my, again, decades of research and a chart analysis, and really have you guys up to speed on an institutional level, not what they post there on X or wherever else the hype comes from, not in the CNBC world or Fox Business. This is the charts and the data. That's what it is, folks, and that's what will honestly put you in a position to generally profit more than you lose. All right, have a great rest of your day, folks. I'm going to go get trading. You guys have a good one. Take care.